So let's start with a number that should not be controversial. Over the last 100 years, the American stock market, specifically the S&P 500, has returned an average of roughly 10% per year, not every year. Some years it climbs 30%, some years it falls 40%. But the long-run average, smoothed across recessions and booms and crashes and bubbles, lands right around 10% annually. That is an established, well-documented fact. Here's a second fact. $100 a month invested consistently into an index fund tracking that market for 30 years at that 10% average return produces just under $200,000. And here's the paradox. According to Gallup, as of 2024, only about 58% of American adults own any stock at all. That means roughly 4 in 10 Americans, people who could, in many cases, afford $100 a month, are not participating in the only machine in economic history that has reliably turned small, consistent contributions into substantial wealth over time. This is not a video about why you should invest. You know you should invest. This is a video about what the math actually looks like, year by year, decision by decision, and why the gap between knowing you should and actually doing it is the most expensive financial mistake most Americans will ever make. Problem 1. The invisible years. The first thing to understand about compound growth is that it is deeply, almost perversely, unrewarding in the beginning. Year 1. You have contributed $1,200. At 10% average annual return, your balance is approximately $1,265. Your gain, $65. If you are someone who makes decisions based on recent results, and most humans are wired exactly that way, this is a problem. $65 is not exciting. And your brain, which is hardwired to seek immediate reward and flee from perceived waste, is going to ask a very reasonable question. What is the point? This is not a bug in compound growth. It is an architectural feature of how exponential curves work. Exponential growth is backloaded by design. The first half of the timeline is the base. And the base is boring, by definition, because the base is just setup. The payoff is entirely in the back half. Year 5, you have contributed $6,000. Your balance is approximately $7,800, a gain of $1,800, and your portfolio is now generating, on average, around $65 a month on its own, without any additional contribution from you, which is, you may notice, exactly what you have been putting in each month. Year 10, $12,000 contributed. Balance, approximately $21,000. Your gain is close to $9,000. At this point, the market is doing more than 40% of the incremental work in any given year. This is when something important starts to happen. Not yet at year 10, but somewhere around year 12 to 13, you will cross what financial planners call the crossover point. This is the year that your annual portfolio returns, not your contributions, just the returns on money already invested, exceed what you are actually depositing each month. At roughly year 12 to 13, you have contributed around $15,000. Your balance is approximately $27,000. The math implies you are generating about $11,000 to $12,000 in gains per year, which means the market is effectively matching your monthly deposit of $100 on its own every single month without you writing another check. The machine has started running itself. Year 20, $24,000 contributed, $68,000 balance. The market has added $44,000 on top of everything you put in. Year 30, $36,000 contributed. Balance, approximately $197,000. For every $1 you contributed, the market added $4.48. $4.48 per dollar, generated entirely by patience and consistency. Problem 2, the panic trap. But here's the problem. The compounding math above assumes something that most investors fail to do. It assumes you stay invested through the corrections. By month 6 of your $100 a month plan, you have contributed $600. And the odds are fairly high that at some point in those 6 months, the market has done what it periodically does. It has pulled back. The magnitude does not matter. What matters is that you open the app one morning and your $600 now reads something closer to $567. You are down $33 on paper. In the market's language, these are called unrealized losses, which means nothing has actually happened yet, except the price tag on your shares has temporarily declined. Your brain, however, does not process this as a temporary decline in a price tag. Your brain processes this as, I made a mistake. This is not working. I should stop. The academic term for this is loss aversion. The behavioral finance finding that losses feel roughly twice as painful as equivalent gains feel pleasurable. A $33 paper loss stings about as much as a $66 real gain feels good. This asymmetry is hardwired, and it is the single biggest structural reason that individual investors consistently underperform the very market they are invested in. Here's the number that puts this in context. A J.P. Morgan analysis of 20 years of S&P 500 returns found that an investor who stayed fully invested earned an annualized return of around 9.8%. Missed the 10 best trading days, just 10 days out of more than 5,000 trading days, and that return drops to roughly 4.3%. Miss the 20 best days, and you're barely above 1%. Miss 30, and you've lost money, nominally, over a 20-year period. The lesson is not that you should predict when those 10 days will occur. The lesson is that you cannot predict when those 10 days will occur. The best days in the last 2 decades largely happened during periods of peak volatility, often within 2 weeks of the worst days. The only reliable strategy for capturing the upside of those 10 days is to not have sold during the 10 days before them. The correct response to seeing $567 where your $600 used to be is close the app. Problem 3, the cost of waiting. The third and most consequential piece of this analysis is the one most people never run, because it requires confronting a mistake they have not made yet. Here's the comparison. Person A starts investing $100 a month at age 25. Over 30 years, through age 55, they contribute $36,000 total. Their final balance? Approximately $197,000. Person B waits until 35, has spent a decade watching the market, maybe participating a little, maybe not, decides at 35 that now is finally the time. But person B has only 20 years until the same target age of 55. To arrive at roughly the same destination, $200,000 at 55. Person B now has to invest $300 a month, 3 times the monthly contribution, for 20 years, contributing $72,000 instead of $36,000 to produce approximately the same result. 10 years of waiting, a decade during which person B could have invested $100 a month without particular financial strain, costs $36,000 in additional required contributions, and still barely matches the person who simply started earlier and invested less. Time is not a soft factor in the compound growth equation. It is the dominant variable. The amount you invest per month matters, the return you earn matters. But the number of years you give the math to work is the multiplier that dwarfs both of them. There is a direct corollary. The question most Americans ask is, how much do I need to start investing? The more useful question, the one the math actually supports, is what is the per-day cost of not starting today? At $100 a month, the daily cost is approximately $3.30. The cost of waiting 1 year to start, 1 year of hesitation, is roughly $3.30 per day, compounded forward across a 30-year horizon. At a 10% average return, 1 year of delay on a 30-year horizon reduces your ending balance by approximately $22,000. $22,000 for 1 year of hesitation. What actually changes? None of this is really about the $100. $100 is the minimum viable entry point into a 30-year compounding machine. It is the dollar amount small enough that the friction of starting stays manageable, but large enough that the math starts working on your behalf. What changes when you start beyond the balance itself is more subtle and arguably more important. The research on investor behavior consistently shows that the single most reliable predictor of continued investment is simply having started, not having invested a particular amount, not having achieved a particular return, just having taken the first action. And once you have started, once that first $100 is deployed, the behavioral math shifts. You begin observing where your money is going in ways that people who are planning to start someday never do. Discretionary spending starts to look different when you are aware of the opportunity cost. The question you find yourself asking is not, can I afford this, but what could this amount become in 15 years, which is a genuinely different framework. This is what some in the behavioral finance literature call the investor identity shift. The transition from someone who intends to invest someday to someone who invests. They are not the same cognitive archetype, and they do not tend to make the same financial decisions. The $100 is the price of admission. The compounding machine, the behavioral shift, the identity change, that is what the $100 actually buys. The most expensive financial decision most Americans will make is not a bad stock pick. It is not the wrong ETF. It is not the year they panic sold during a correction. It is waiting. Waiting for more certainty, more comfort, a better time, a higher income, until enough time has passed that the cost of waiting has become larger than most people realize. The math does not care about your feelings about the market. It does not care about interest rates or election outcomes or whether the economy feels uncertain. It cares about one number: how many compounding periods you give it to work. Start small. Start now. Understanding money is your best defense.